Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and co-founder of the Dividend Kings subscription service and the marketplace on Seeking Alpha. And this particular video is going to be in conjunction with the article that I recently published talking about whether your retirement portfolios, common stock portion of your retirement portfolios, should be concentrated or diversified. And in that article, I did present 5 example companies that I felt were all fairly valued. But many of you who followed my work for a long time know that one of my favorite mantras or refrains is that it's a market of stocks and not a stock market. And so what I'm really trying to do here is illustrate 5 very distinctly different types of companies. I've got some growth stocks, I've got some high yield stocks, I've got some moderate yield stocks, and some low yield stocks in this little universe. And what I'm really trying to accomplish here is to show you what kind of choices that you might have when you're trying to construct a dividend growth portfolio or even a retirement portfolio that still needs some growth. So you could blend these together, but these are some of your different options here. So I'm going to start out with Enbridge Inc. here, which is a oil and gas pipeline company. And I'm using EBITDA here because when you're looking at oil and gas pipeline companies and MLPs, the thing you want to look at are cash flows primarily. And EBITDA, which is earnings before interest, taxes, depreciation, and amortization, is really a form of cash flows. And from a valuation perspective, when you're valuing MLPs, I think EBITDA is one of the best metrics that you can utilize. It also gives you an idea of how well the dividend is covered. But what I want you to notice here, this orange line on the graph that I have here is a normal or price to EBITDA for Enbridge of 7.8 times EBITDA. Currently, the blended price to EBITDA on Enbridge is 6.19. So the price is currently below the orange line, which would indicate that this is attractively valued. I also want you to notice the dividend yield is 6.62%. So this is a above average growth and high yield company. The EBITDA growth rate's been about 8.36%. So let's take a quick look and look at performance here and see how that performance has translated. I want you to notice that when you look at performance going back to December of 2000, you'll see that this company generated a bucket load of dividends. $10,000 would have thrown off $23,592 worth of dividends versus only $3,753 in the S&P. Now, if you're investing for income, this is a clear example of a company that over the long-term history here has outperformed the S&P from a standpoint of income generation, but it's also outperformed it at a capital appreciation. And I want you to notice that capital appreciation was pretty close to that growth rate I showed you before. But when you add capital appreciation plus dividend income, and this is dividends not reinvested, I always like to look at these like this because I want to see what the company's actually generating. If you reinvest the dividends, that's the same as adding capital. So this is a one-time $10,000 investment. The return was 11% versus 5.4% in the S&P. So if we look at that, I want to make sure you understand a couple of points here. Number one is the price to EBITDA was actually low at the time that we started measuring the performance here. It was 5.16. It's currently 6.19. So, we got a little bit of PE expansion, which explains the higher than the growth rate, but it was obviously very highly correlated to the company's growth rate. But the dividend income that this company generated, let's go back and look at that. You can see the company raised their dividend each year here throughout this time frame. They grew their dividend by an average of 13.6% and a compounded average growth rate of 13.4%. Now, the next thing I'd like to do, I'd go ahead and like to take a look at Enbridge from an operating cash flow, but when I do this, just to be clear, I want you to understand that I'm looking at dividend coverage here more than I am valuation. So as you can see, there is a correlation between operating cash flow and valuation. So this would be extremely cheap if we were using operating cash flow as a valuation metric. I'm going to take price off. What I'm really trying to see here is the operating cash flow, the orange line here, higher than the white line, which is the dividend income. In other words, is the company's operating cash flow covering the dividend? The answer is clearly yes. So here we have a 6.62% opportunity that's produced a lot of dividend income, and this is one of the 5 examples that I'm showing, and this is one that the Dividend Kings has recently added more to their portfolios for those of you who are subscribers. With my second example, I'm going to go ahead and look at Simon Property Group. Best way to, it's a real estate Investment Trust, a mall REIT. This is one of the higher quality A-rated real estate investment trusts on the planet. Now, this is the funds from operations. And, those of you who understand REITs know that they have a unique capital structure and they have a unique requirement to distribute 90% of their distributable income. So this turns out to be the best metric for valuing REITs. So I'm going to put monthly closing prices on the graph. And I want you to notice that the company's stock price has correlated to its funds from operations here. And when it was cheap, below the orange line, if you will, this was a great time to buy the stock. Anytime the price got above the orange line, there was usually a reversion to the mean on the downside, and you can see it here on numerous occasions. And currently, this company is available at a very attractive valuation. The price to FFO is only 13. The company's dividend yield is 5.14%. If we look at it from a standpoint of historical performance, once again, a $10,000 investment in December 31st, 1999 would have thrown $35,800 in total cumulative dividend income versus $3,482 in the S&P over the same time frame, but it would have also turned $10,000 into just under $76,000. That's a 10.5% capital appreciation or growth component. Add the two together, you get 13% versus 4.6% for the S&P. But again, I want to emphasize that this stock was extremely undervalued in my opinion back beginning of 2000, the end of 1999 as I measured. And you can see that the price has tracked the FFO growth, and FFO growth here has averaged about 6%. But that extra performance is a function of what I would call undervaluation, moving up to a higher valuation going forward. As another valuation reference, I want to look at dividend yield because this is important. This is a mirror image of the price. I want you to notice that when the dividend yield of this company was extremely high, like here in December of 2000, it was 8.95%. That just shows you how cheap the stock was back here. And then when the dividend was also 7.21% in 2008 was the time when the stock price was trading at one of the lowest prices to FFOs on the graph. And you can see the dividend yields were much lower here, 3.25%, when the valuation was very high. Here we are down to 3.6%. So 5.14% would be a good dividend yield for this company at this time. Another indication that it's fairly valued based on fundamental metric. Now, with the first two examples, I was showing higher yielding opportunities that still had some capital appreciation. And I hope you all did notice that the idea of owning a dividend growth stock strictly for the income is kind of ludicrous. If you buy them at attractive valuations, you could also generate really nice capital appreciation as well. So my next example is a moderate to slightly above average dividend yielding Ameriprise Financial. It's A-rated, has 40% debt. It is an investment banker and broker, so it's kind of a multifaceted financial institution, if you will. And here we're looking at adjusted operating earnings with a fair value PE ratio of 15. That's the PE of the orange line. And once again, you see in the long run, the price goes where the company's earnings go. You see periods where the valuation got very low. Here we got down to a 4 PE. These would have been a great time to be buying the stock. It's currently trading at a 9.7 PE. That's a significant discount to its theoretical fair value. If I look at the normal PE over this time frame, because it is a financial, you'll see that the normal PE has only been about 13. 12.8 is what the blue line here. But regardless, you can see the company is still very inexpensive relative to that. Now here we're looking at an 11% growth rate over the time frame that I'm measuring, which is really from September of 05 to current. So if I go into the performance report and I keep that 11% growth in mind, I want you to notice that the capital appreciation component was almost perfectly in line with the company's operating growth. That's the advantage of buying valuation. You participate in the company's growth. Now, even though the dividend yield was relatively low compared to the other examples, this company still produced more dividend income than the S&P 500 because look at the growth rate of its dividend. It's been absolutely phenomenal. Now, that's been a little distorted by one big year here. So if I shorten this time frame a little bit, just look at, let's say, the last 10 years or so, you'll notice that the dividend growth has still averaged over 20%. The last 2 years, it was 11 and 9. But again, once again, you can see that in this different time frame here, it still outproduced the S&P on dividends and it outproduced it on capital appreciation. You can make both attractive dividend growth rates, plus you can also make good capital appreciation or total return, as some of you like to call it. Now here we had fair value based on this normal PE of around 13, 12.8 to be precise on the blue line. And even though we've got a discount valuation to that right now, we still generated a very nice rate of return. return. So Ameriprise is another one that looks very attractive. From a forecasting point of view, this could generate very substantial total returns, but with moderate dividend income of about 2.6% or just under 2.6%. Now, moving on with my next two examples to give you, I've showed you a pretty high yield, a moderately high yield, and then just a slightly above average yielding stock. Now I'm going to move on to Cigna Corporation, which is managed healthcare. This is more of a pure growth stock. If you look closely here, you'll see that they do pay a very, very low dividend. In fact, their dividend payout ratio is minuscule. Their dividend yield is less than 1%. So this is about as close to a pure growth stock as you're going to get. I do want you to notice that based on a PE ratio of 15, it was reasonably valued at the beginning. It's undervalued now, but note the growth rate of 13.54%. Considering that the stock is currently undervalued, it ended up averaging about 11.9. But here you have a case where there was virtually no dividend income relative to the S&P. But here you have a growth component. 10,000 grew to 46,000 since 2005 compared to 24,000 in the S&P. So you have a 12% total return versus 7.7. Now this is much more growth oriented, but you can see that if you were looking for pure growth, a couple of things here. You don't have dividend income coming in to give you some, I'll call it risk mitigation. So you're strictly buying growth. And you can see that there have been times where this company's stock price has been rather dramatic. Here's a 69% drop in stock price from September of 07 to October of 08, which of course was during the Great Recession. But we also see some pretty volatile periods here. This is one of the aspects. Here we have 27% growth. And then most recently, when the stock was actually moderately or reasonably valued, we did have this drop from peak to trough of about 34%. So you do get a lot of volatility here with no dividend income to kind of smooth the way for you, if you will. But this is Cigna. And then my last example, I'm going to go on to Facebook, which is a pure growth stock. And the example here is pure unadulterated growth with no dividends. The thing I want you to notice most, I even want to take price off of this graph, is this company has grown earnings. This is operating earnings here at over 36% per annum. So I'm using a PE equals growth rate of 36.29. So this orange line is equal to the company's growth rate. And when a company is growing fast like this, it does command higher PEs because of the compounding. Just look at the earnings growth here. Earnings went from 53 cents in 2012 to $6.16 by 2017. Last year it earned $7.57, and by the way, is expected to have its first real down year during this time. Now, when I put price on here, we can see that PE ratios were actually quite high back in 2014. But let me show you something here. Even if you'd have paid a PE of just under 67 to buy Facebook in February of 2014 and held it to yesterday's close, you'd have still made 21% a year. And that's even considering that based on these prospects here, the company is significantly undervalued. Now, I do want to make a point. The future growth of this company, if I go to forecasting, is expected to only be about 15%. So if you're looking at a normal PE of around 35 or so, this Facebook would still be undervalued. But keep in mind, its growth rate is expected to slow down dramatically. So I wouldn't be too sanguine about buying the future here at these valuations. This reset of value here might actually make sense. If I shorten the graph here to a 5-year graph, you see that growth since 2017, that would be 2017 and 18, and expectations for 19, has dropped to 21%. So now this orange line is a PE of 21. So, the point is this is pure growth. But if we look at this company's performance, as I did with all the others, a $10,000 investment on May 31st, 2012, and that would be on the original, public offering of the company. I do want you to notice something, though, that people don't understand. From the IPO, the stock did drop 40% from May to August of 2012 when it first came out. But again, because it's growing so fast, it still made a great deal of money. The total rate of return with no dividend income at all was over 30% annualized versus 12 for the S&P. So growth stocks can have their place when you're buying them in the growth phase. But keep in mind, companies that have now, this company's a $558 billion market cap. Obviously, it's going to be much harder for it to grow as fast as it did historically. So what I've done here is I've shown you 5 companies that are all technically in value, perhaps with the exception of Facebook, based on the fact that its growth might slow. But I want you to understand here, what I'm really trying to get across is there are a lot of choices. We're currently buying Enbridge, imagine, we're currently buying Simon Property Group in the Dividend Kings portfolios. Those of you who are subscribers can check it out there. But the bottom line is what I really wanted you to see here, that it is a market of stocks, not a stock market. And stocks have a lot of different attributes, different dividend yields, as you can see here, ranging from 0 up to 6.6% on this particular group of companies. So, when you're building a retirement portfolio, it's important to recognize that you do have lots of different choices, and how you mix and match and blend those choices can make all the difference in how your portfolio performs over time. But it also makes a lot of difference in the amount of risk you're taking, makes a difference in the amount of income you're receiving. So as I say in the article, you want to build a portfolio that meets your own specific goals. Don't worry about trying to beat the market or not. Try to build a portfolio that makes economic sense for you. This has been Chuck Carnevale saying thanks for watching. And if you like what you saw here, please hit our subscribe button. And those of you who are interested in learning more about the Dividend Kings, check us out on Seeking Alpha. Thanks.